Credit cards versus savings account. Neil and I were just having a good conversation with regards to one of our clients that called in this morning looking to get pre-approved. Now, it didn't start off with this. It started off with her credit score being a little low, and she wasn't sure why. So then, doing our soft fact finders we always do, where we don't pull credit, we were asking situations about what's going on with their credit and their finances. What I learned is she had $900 on a couple credit cards. She said she had two of them with at least $900 and a couple more. She also had $7,000 in the bank, which is pretty good, right?
Very good.
At the end of the day, though, when you look at the math, is it so good?
No.
Let me explain why it's not, guys. $900 credit card, average interest rate. Now, I asked her what she said her interest was because she happened to just look, and she said it was around $14 to $15. The average interest rate on $900, you take $900 times 17.99% and divide by 12. That gives you your monthly interest rate. Now, when you think $13 on interest isn't so bad, but how much money are you making on $7,000 in your savings account?
Zero.
Minimal. Average savings accounts around 0.25%. Not 25%, not 2.5%, 0.25% interest. On $7,000, you gain $1.45 a month. So when you look at your finances and your budget, what's better? Paying off this credit card that's costing you $13 a month in interest, times that by 5 credit cards. I mean, that's only, we'll say $1,000. There's people that have $2,000, $3,000, $10,000 credit card debts. Versus the $7,000 in interest, you're only gaining $17 a year versus $13 a month, guys. It's so important for you to understand this. This is the stuff that people don't know. We're not taught this stuff. And so people don't realize that they're bleeding themselves dry because of interest. And I don't care if it's your credit card interest. I mean, what's the big difference? Let's say somebody refinancing today. If somebody went from 4% interest down to 2.75, how much does that save them?
It depends on the loan.
Let's say it's an average $250,000 loan amount.
Probably $250, $300 maybe.
It's a lot, guys. These are the little things that people don't take the time to learn, but it impacts so much of your life financially. And then outside of financially, it affects your emotions, it affects your happiness.
Not only that, yeah, you might not have $7,000 after you pay those credit cards, but because of the compound interest and the money that you can save, you're going to save it back up faster because you're not paying the credit cards.
Yeah.
And the most important thing, why? What was the reason she came? Her scores will go up.
Right, so these things, 2 of these cards, guys, were close to maxed out. When your credit cards are maxed out, we talk about this is another video, but you have a total utilization factor, and then you have each individual credit card utilization factors. By having one card maxed out, that may cost you 25 points just for that one credit card.
Maybe more.
It could be more. It depends on the number of cards you have, and it depends on the balances and all that stuff. But the idea is this, guys. You have to understand basic economics or basic finances, that if you have a $900 credit card that you carry a balance on, and you have $7,000 sitting in your savings account, unless you need that $7,000 tomorrow, pay this off and stop bleeding yourself dry financially. All right? I know that's a little long. I know that's hard. This is like that tough love that you want to hear, or you don't want to hear, but you need to hear, because it's going to help your finances and make your life better in the future. All right? If you guys have questions on this, let us know. It's definitely important for you to think about it, guys.
Pay the credit card off.